Hi everyone, Anton Madley with Peak Market Watch, together with my colleague John Matthias. Hi John, how is it going?
Hey, going well, Anton. And once again, I have no idea what rates are going to do.
Yeah, no one knows, but at least I think we got some indication yesterday with the meeting that concluded. So why don't we quickly just go through what we have
Oh, yeah. Sounds good.
seen here, right? Which is certainly not. I would say nothing was really a surprise, right? Uh, so the announcement was as expected, the 50 basis points. So now we have a target rate of 4.25 to 4.5. Nothing surprising there. Uh, Now, I think what is kind of important to really point out, right? It's he repeated it in his statement publicly when he had the press conference that maximum employment is a key uh, achievement that they need to achieve, and then that the inflation target of 2% over the long run. Interesting was during the Q&A session, someone asked whether potentially that 2% could be raised. And initially said there is no discussion whatsoever that that would happen. But then I think he qualified that it might be a discussion point down the road, but solely in the near future, and I would say we probably talk about a number of years. There is unlikely that they are moving away from that target. Naturally, some people argue, well, 2% is too low, particularly when we consider the changes in the overall global infrastructure and supply chain. So there is a lot of pressure for ongoing cost increases on the supply side. So it should be raised, but. Whatever someone is arguing, I think for the next few years they probably will stick to that 2%, right? Uh,
Yep.
Now, I think also he made it clear, and that's why the stock market didn't respond too well over the last 2 days, is that ongoing increases of the target range will still be appropriate, right? Many have hoped that this might be the last raise, and then may not be another raise in February, and that there potentially would be a cut uh, in later in 2023. And again, when you listen to the Q&A after the press conference, after his speech and then during the press conference yesterday, he definitely made a clear point that their overall expectation is that that target rate will stay elevated at wherever that so-called terminal rate is going to be. That they will be very careful to lower that rate too soon, referring again to the 70s and 80s when they felt that in the initial period that they lowered the rate too early, which then created a whipsaw effect where inflation again increased afterwards. So I would say that was at least from my perspective, that was the key takeaway, that markets anticipated that there is a good chance for the Fed lowering the rate sometime in 2023. And I think he's only threw cold water on that hope. What's your take on that, John?
Yeah, thanks, Anton. I don't think I have any different observations than you. The one thing I'd add though is So I think that, folks that maybe watch capital markets closely, they get all of the discounting effects and how this gets extrapolated into expectations, and then, appropriately, different rates or levels in the equity markets would adjust accordingly. But I think that, for our listeners and investors that are of different sophistication levels, it kind of, what you just commented upon, that he put cold water on the expectations of a rate drop in 2023. Contextually, it just kind of highlights that, we've been in this expectation and of always, being in a low rate environment, or at least, let's say, within the last decade, of very cheap money. And, historically, while that may be a necessity, or in our modern economy, so to speak, that we have lower rates, but, there really is no mechanism that requires that the Fed has to be there, constantly trying to have the lowest rate possible. As he commented throughout, in his remarks, they're driven by managing inflation and kind of maximizing unemployment at a level that would allow for that. So, it seems as if, there's just that there's probably a need for investors to kind of continue to make even further adjustments in their expectations of, what type of cost of capital am I going to need? What will be my borrowing costs? What's the appropriate discount rate for assets? And I don't know if we'll see that in cap rates, but yeah, I just wanted to comment on the idea that, this, we've been out of that viewpoint of lowest rates, where we've come out of this historically low environment. But yeah, it just highlights that, there's nothing to force the Fed to have rates lower than where we are, unless it is constraining the economy in a way that allows them to reach their goals, and then, hopefully they'll adjust appropriately from there. But yeah, there's no guarantee, so to speak, is I think is what I'm trying to comment on.
Yeah, that's definitely right. Right. He also mentioned, look, we are going to see pain, right? So he acknowledges unemployment rate has to go up, and again, he has pointed out it's at the record low and extremely healthy, right? So as a job market, so he certainly expects that to go up, and almost signals that it needs to go up. Uh, and when it comes to the economy itself, right, I think many people expect, well, if we enter recession, then they'll lower the rate. Well, if we get into a severe recession, then it's the economy is collapsing, then maybe. But if it's just a recession that is maybe minus 0.5, maybe 1%, I don't think that we will see those rate reductions a lot of people are hoping for, right? My take really is that as long as we are not getting into a very severe recession, the Fed is going to keep the rate as high as they feel can be sustained by consumers, by businesses, as well as the federal government, right? So
Yep.
obviously there is a limit with the debt burden that everyone has until something is going to break. But as long as they feel that it's not going to break, they are not inclined to lower to rates that we have seen for a very long time, and obviously during COVID. But even pre-COVID, we had these record low Fed fund rates, and I just cannot see that they are going back to those levels. Right. Having
Yeah.
said, obviously they still have the way out here, right? So that mentioning that we are prepared with just a stance as appropriate if risk emerged that could impede the attainment of the committee's goal. So in other words, if things all fall apart, don't blame us if we then still lower the rates faster or not along the lines than what we have projected, right?
Yep.
That's not really a surprise, but I think things need to break pretty significantly, in my view, for them to do that, right? To really go lower. Now, I think what is certainly interesting to see is that clearly when it comes to the 10-year Treasury, there is certainly a view that we are entering some form of a recession, right? We have had higher, much higher 10-year Treasury rates. We were significantly higher, all the way up close to 4.5, maybe around 2 months ago. Now we are obviously at around 3.45, which certainly is an indication that we may enter a recession. Whether we do that, who knows? But that's kind of the indication that that the market is giving us here. Now, is that helpful for borrowers? Absolutely, right? Is that potentially then triggering more inflation pressure? Absolutely, right? When we talk about again the consumer, if they can borrow cheaper, that they will consume more. If mortgage rates come down, maybe then the housing market will start to increase again from a price point perspective, and that's definitely not what the Fed wants to see. So I think again, right, we likely will see some bottom there on the 10-year too. Is that at 3.5? Is it at 3%? Who knows? But I think if someone is hoping that we will get back to the levels we were doing pre-COVID, and then during COVID in particular, where the 10-year Treasury went all the way down to the roughly 0.5% mark, I think that is unlikely going to happen. Obviously, the Fed can only control the longer term yield curve so much, primarily with purchases, right, and dispositions on their balance sheet, and some regulatory influence on the lending side. But I just cannot see that we will get to these levels. So at the end of the day, I think in my view, we have to live with elevated short-term rates, and still, while might possibly a little bit lower, but still comparatively much higher long-term rates certainly for the next year, right?
Yeah, and one quick question, Anton, and that's all I have left. Is just as you're looking through pro formas and looking at deals that have been sized by investors, do you feel that investors are making the appropriate assumption on exit rates as far as either refi, or where they, if maybe they're looking to refi to return capital? What do you think about some of the investor assumptions you've seen, here in the last month and a half or so? Do you think folks have made the correct adjustments, or are folks still maybe too a little aggressive as far as what they're thinking about as they're sizing deals?
Yeah, I think many are still a little bit on the aggressive side, because many anticipate that interest rates come down, right, and are willing to buy properties, sometimes still with bridge loans and or short-term loans, even if it's a Fannie or a Freddie or another short-term loan, anticipating lower rates down the road within a year or two, with the hope that they can refinance at that point, right?
Yeah.
And that is what we solely have seen. I would say that's still a relatively risky approach. Obviously, if you're a sophisticated investor or deal sponsor and you're comfortable with that, more power to you. right? But the reality is, as soon as you move into short-term borrowing, you if things go against you, i.e., rates go higher or stay much higher than what you anticipated, you're certainly not in an easy spot when you have to refinance within 2 years or whatever it might be.
Yep. Yep. No, great observation. And
Yeah.
that would be my same insight as well. Great. Well, thanks for sharing that.
Yeah. All right. Thanks everyone for joining us. If you have any opinion where rates are going, please post them in the comment section. We all have our own crystal ball, but obviously we look back in a year from now, and some of us will be right and some of us will be wrong, as always. Thanks again for joining us.